Welcome to the Quarter Economic Update for Q2 2021. I'm Chris Fletcher. I'm the Director of Policy and Communications at the Chamber of Commerce, and I'm going to be hosting the event today. We should be finishing around about 10 o'clock, so it's just an hour or so of the latest and what's going on within the local economy here in Greater Manchester. Subrah, if you can just move the slides on, please. Doing me Chris Whitty impression there. Okay, so today, welcome and introduction, that's what we're in now. Then we've got the QES presentation led as ever by our Head of Research, Subrah, and then we'll have some time for questions and discussion at the end. So if there's anything that you see or want to find out a little bit more about, that's your opportunity to do it. But first of all, as ever, just what is the quarterly economic briefing about, and more importantly, what is the QES? Well, as the slide says there, it's the UK's largest and most reliable business confidence survey. It's obviously published every quarter, but it's also one of the first ones to be published every quarter as well. Greater Manchester QES, the sample size that we use is more than some other national surveys actually have as well. So we've got well over 300 results already for this quarter as well from businesses in Greater Manchester, and that's the most important thing. It's obviously very reliable. It's accurately predicted recessions in the past. The one thing it didn't see was obviously COVID-19, but then again, who did? But obviously where things are happening in the economy, this is a great way of picking up on those very, very early stage signs of economic impact and doing something about it. Does first really matter? Well, we think it does, because it helps us to be a little bit ahead of the curve. And people going about the Office of National Statistics and government stats and one thing or another, at best they're probably a quarter out of date. This is information that people were supplying to us, that businesses were supplying to us a couple of weeks ago. So it's banged on the money. It's as virtual real time as you're ever going to get on such a comprehensive economic and business survey. We don't wait for what was happening 12 months ago. We know what's happening here and now in Greater Manchester. And what happens to QES? Well, obviously policymakers do it. It's part of the bigger survey the British Chambers of Commerce do. That goes to Treasury, the Bank of England, key government departments. We also use it here in Greater Manchester as well, with the Combined Authority, the Mayor's Office, local authorities as well. And also, as well, if we're getting it all right, as the line says there, businesses use it as well, because this is a great barometer and a great look as to see what's actually going on. And we know that businesses use that to help make the decisions and planning process in the future. So that's what the Quarter Economic Briefing is all about. And just to do a couple of things, please ask people just to mute the microphones, please, then we don't have any bumps, noises, doorbells going or anything like that in the background. There'll be opportunity to put questions in the chat box as we're going through, and I'll try and get as many of those in as possible. And we are recording the event as well, so we can use it on our YouTube channel and for people that can't make it with us today. So anyway, without any further ado, hand you over to the main part of the presentation, and as ever, great to introduce our Head of Research, Subrah. Subrah, over to you.
Thank you, Chris. Good morning, everyone. It's an absolute pleasure to be presenting the QES from Elliott House, a pleasure that has been denied us for 15 months. So things are getting back to normal in a sense. So thank you, everyone, for joining us today. You know, this is a very sort of positive and hopeful time for us, even though the spectre of COVID-19, the fag end of COVID-19 hangs over us. But having said that, there is a lot of optimism, as I will go through in the results. Of course, thanks to those of you who did fill in the survey. It is highly appreciated, not least because what I am presenting is informed opinion on your views. So you business leaders and business managers in Greater Manchester have given us your views through the QES. Over 300 of you have responded to the QES this quarter. And what I'm presenting to you is just your own views. You know, it's an aggregated version of the views of Greater Manchester businesses. So what are we going to look into this morning? First up is the Greater Manchester Index. The Greater Manchester Index is the single most important economic indicator for our city region. I'll go through business confidence, domestic demand, overseas demand. I'll go through some analysis of how the different sectors are performing, some employment numbers there based on QES data, and of course, the macroeconomic outlook as well. So for those of you who are new to the QES, what is the Greater Manchester Index? Now, the Greater Manchester Index is, as I said, the single most important economic indicator for our city region. It's made up of 7 separate QES measures, and those measures are domestic sales, domestic orders, sales and orders from overseas customers, business confidence, confidence in turnover and profitability, and also capacity utilization. So those are the 7 measures that go into the calculation of the Greater Manchester Index. And that's your key takeaway, if you like, from this morning's presentation. Okay, so what is the economic context that we are operating under at the moment? Now, as a recap, in the first quarter of 2021, we entered the 3rd national lockdown. So there was some optimism way back in December, January. There was a bit of a dent in confidence with the 3rd national lockdown and rising infections. But the Prime Minister, of course, announced the roadmap out of lockdown. And to an extent, we have been able to follow that. As a result of it, there was some optimism even in the first quarter. So the Greater Manchester Index was at 6.1, plus 6.1. It went into positive territory, crossed that 0 line after a gap of about 9 months. But in keeping with what was happening nationally, UK GDP declined by 1.5% in the first quarter. Now, that is almost distant memory now, because the latest results, the results for this quarter, the second quarter of 2021, show a robust rebound with business prospects improving across all the sectors. And the sectoral divergence is to an extent narrowing down. There has been improvement in customer demand. I'll talk a bit about that later. International trade activity has picked up. That's definitely good news for exporters, but also businesses that rely on imported raw materials for their operations. But Brexit challenges do remain. And even 6 months after the UK-EU Trade and Cooperation Agreement was signed and ratified, businesses continue to face problems with Brexit-related issues, primarily in moving goods and services across the border. The other interesting and important thing is that cash positions have improved this quarter. So confidence is stable. And as a result, employment prospects have also gone up. But here is the kind of concerning aspect. For the past 12 months or so, employment prospects were not very high. Many employees were on furlough. Recruitment was probably not as high as it could have been during normal times. And so many businesses did not face any recruitment difficulties. But as soon as the economy has started opening up, things are looking up and businesses are trying to recruit, recruitment difficulties have suddenly popped up again. So these are age-old problems that have never really left us. The pandemic just masked over it. But those problems are coming to head again. Okay, so that's the economic context that we are operating under. So where are we this quarter? The good news, and this is your key takeaway, as I was saying earlier, the Greater Manchester Index for this quarter, the second quarter of 2021, is at 30.4. So that's a 24-point improvement upon the first quarter. So in the first quarter, it was 6. Now it's 30.4. So excellent improvement in the Greater Manchester Index, and general optimism in the local economy and national economy as a result. So that's great news. Now, GDP is forecast to increase by between 4 and 5% in the second quarter. Again, that's a significantly higher growth compared to what we have had in the last 2 quarters. We expect there to be a substantial amount of growth in this quarter and the next quarter, and then coming into 2022 is when I think GDP growth is going to go back to trend. And by trend, it's, on average, every quarter we get probably 0.5%, 0.6% growth. I think we might reach those levels only in 2022, but this year is the year of growth, unless there are serious further disruptions, of course. Okay, the rebound has been seen in all sectors. So until this quarter, it was manufacturing and to an extent construction that were leading the pack, as it were. Service businesses were struggling, and of course that is understandable because it's the services sector, hospitality, retail, etc., that had these restrictions applied to them, and so they couldn't operate. They've now started operating, and clearly service sector growth has come back. So that rebound is being seen across all the 3 main sector groups: manufacturing, construction, and services. But of course, there have been some behavioral changes as well in the last 12-15 months. E-commerce, many of us are buying lots more online than we would probably do in the shops. Clearly, retail has had a massive churn in the last 12, 15 months. High street chains have disappeared. E-commerce is still going very strong. 2.5 billion in weekly sales across all formats are taking place now via the internet. Before the pandemic, it used to be between 1.8 to 1.9 billion. So that's a 20, 30% increase, and that is being maintained even now. Now, it may be that, towards the end of the year, and that might go down, but as of now, e-commerce is really strong, almost 30% up than it was during the pre-pandemic levels. There are no sectoral differences. I shouldn't say there are no sectoral differences. Sectoral differences are actually narrowing down, but some geographical divergence is now emerging. And we will look into that in a moment. Okay, so first up, so I told you the Greater Manchester Index is at 30.4. We are now going to look into the component parts of the Greater Manchester Index. First is domestic demand. And the good news is domestic demand has actually gone up. That is quite visible from what we have been seeing just across us. The city center looks a lot busier. There is more custom, there is more trade. So domestic demand has gone up. Now, from just about zero in the first quarter, it has actually gone up to the mid-20s. That's true for both domestic sales, i.e. sales that have taken place in the current quarter, but also advance orders for the next few months or quarters. So domestic demand, i.e. customers from the UK buying goods and services, has actually gone up. Now, I mentioned geographical divergence. So the chart on the right has got the domestic sales data. So it looks into only one of those two measures. Domestic sales has been split across the three geographical sub-regions within Greater Manchester. What we do usually is to combine the northern boroughs, the 5 of them, starting from Wigan, the northwest, to Oldham, Rochdale, northeast, Salford, Trafford, Tameside, and Stockport in GM South. And then Manchester City is on its own as Greater Manchester Central. And so the one thing that we can see is that Manchester Central is doing the best at the moment. Again, it's Manchester City that has got the highest concentration of hospitality, retail, etc. And it is completely understandable that that's where the maximum demand is getting concentrated now. So Greater Manchester Central, Manchester City is doing really well at the moment. So domestic sales is up to 40. Just a note, I should have mentioned this earlier. These numbers and the lines that these numbers represent are balances. They are not percentages, they are balances. And the balance is the difference between the proportion of the positive response to a question and the negative response to a question. And so plus 40 would mean that a lot more businesses are actually reporting that their sales have gone up rather than those who are saying that their sales have actually declined. Now, Greater Manchester South seems to be doing the weakest at the moment. And again, I think this is just because of the sectoral mix in different areas. And again, that divergence might narrow down in the coming years in Q3 or Q4. Okay. So domestic sales and domestic orders have improved in this quarter. So that's looking at it from a geographical lens. How does it look when we look at it from a sectoral lens? Again, significant improvement. Construction, of course, leading the pack there. So 3 lines there on both of these charts. The dotted green line is it represents the construction sector. The construction sector is very interesting because it started to an extent recovering towards the end of 2020 itself. So there was a period of disruption, probably 5-6 months of disruption in the construction sector, but activity started picking up towards the end of 2020. That seems to be sustained at the moment. We did some research on behalf of Manchester City Council recently, an analysis of the pipeline of construction projects. And we know from that analysis that the construction sector is doing extremely well at the moment in Greater Manchester. And we expect output of about 5 billion in 2021 and another 5 billion in 2022. Now that's about 20% to 20 to 25% higher than what we have seen in the past. So a significant amount of activity taking place in the construction sector, and we have talked about this before in previous events. Just look at the number of cranes and building sites in the city, and that's all construction activity that's contributing to economic value add. Manufacturing and services have also picked up. Manufacturing, again, was doing better than services in the last 6 months or so. But again, that divergence is narrowing down at the moment. So construction leading the pack, but manufacturing and services not really far behind. So again, the balances are in the mid 20s. So that's domestic sales, current sales that have taken place in the quarter. What about advance orders? A very similar picture again for advance orders. Construction again doing up, so the balance is approaching plus 50. So a significantly higher number of businesses are saying that their trade and activity levels are going up. Manufacturing and services again in the mid 20s, so slightly lagging behind construction, but again, things are catching up really in both services and manufacturing. And what is very important is that the divergence is narrowing down, and the reason I stress upon that is because more than 80% of our local economy, but also the national economy, is made up of service businesses. And so unless we have a significant amount of growth in the services sector, we are not going to see overall economic growth, which is why the services sector is extremely important for us. Okay, so that's looking at domestic sales and domestic orders from a sectoral lens. Let's look into cash flow positions. Now, clearly cash has been a concern. Many of you would have been concerned about cash positions, how to manage working capital, etc., in the last 12, 15 months. For the first time since the end of March 2020, cash positions have turned positive. And that is a significant milestone to cross. And they have rebounded fairly strongly, I would think. So for all three sectors, a significant improvement. In approaching plus 20 at the moment for all of those three sectors. Again, cash flow positions are extremely important. And I think what is likely to happen is that businesses, are going to take in cash, and they're probably going to put that in a little amount of reserves, because for those of you who may have taken up COVID-related loans or may have deferred tax liability, obviously the buildup of cash flow and working capital is extremely important as and when those repayments start. Therefore, cash flow positions improving is actually a very good sign. And that is almost a precursor to further employment, business investment, etc. But we'll get to that later. So cash flow from a sectoral lens, and what about looking at it from a geographical lens? And again, the thing to point out is Manchester Central is doing slightly better than the other regions, but the balances are very similar. So Manchester Central, which is the city, approaching almost 20. Greater Manchester South again lagging slightly behind at a balance of just over 10. And then Greater Manchester North sort of in the middle there, so a balance of around plus 15. So again, for the first time since the end of March 2020, cash flow positions have turned positive. That's a good sign of economic recovery. Now, we have to keep a very close eye on cash flow positions, and that's because the experience in China and South Korea suggests that business failure actually went up during the recovery phase from COVID rather than during the decline phase of the recession. And I think that is because businesses expend cash, staff are being brought back from furlough, so salary payments are now due. Obviously, stock has to be built up for sales and trading activities. So for all of those reasons, cash flow positions have to be strong, and we want to see that improve beyond where it is at the moment. Okay. So cash flow positions improved. What about international demand? And again, international demand is extremely important. This is an area where there has been a lot of volatility. If we cast our minds back to late 2018, early 2019, we had some severe problems with international trade. There was a Brexit deadline, which was due at the end of March in 2019. We saw a huge amount of volatility in 2019. In 2020, towards the end of 2019, we saw, again, some volatility and stock buildup, etc. But 2020, international trade took a hit. It took a hit because of supply chain disruption, because of shipping disruptions, huge increases in the cost of shipping, etc. But now international trade is slowly starting to recover globally. But from the UK point of view, obviously, we have Brexit as well as an additional variable that affects international trade. But International trade again has crossed that zero line and entered positive territory the first time since the end of March 2020. So that again is a very good sign. So on export sales, manufacturing and services both improving. Services actually doing better in international trade. The UK exports more services than it does on manufactured goods. So plus 15 is the balance for services. The balance for manufacturing is at plus 10. And a somewhat similar picture for advanced orders, actually slightly better. The balance is about plus 15 for manufacturing, and then services just about 10. So again, the recovery in international trade is positive. Having said that, what we do know is that the overall volume of exports is still lower now than it was in 2019. So if we compare May 2021 with May 2020, things have picked up. But when we compare May 2021 with May 2019, things are not looking that great. And we, of course, have a proxy for international trade activity, which is the export documentation processing that takes place in the chamber. So is Brexit having an impact? Brexit is still having an impact. It is affecting both the trade in goods, but also trade in services. But it's 6 months since the trade and cooperation agreement was signed. So more and more businesses are probably getting used to the new regulations, to the new paperwork requirements, etc. And my colleagues in the international trade team at the chamber have handled many hundred calls asking for specific advice and information about Brexit-related issues. So what we have seen in the answers to these two questions is that the proportion of very difficult responses, both on the trade of goods, but also in the trade of services, the proportion of very difficult responses have gone down. The proportion of moderately difficult and moderately easy responses have actually gone up. So that's clearly a good sign. It's a sign that businesses are probably getting used to the new paperwork. Now, that is not to say, there is a significant increase in exports. Now, what I would like to do is Susana Cordova, our head of international trade, is in this event. So, Susana, do you have any comments about export documentation, Brexit, international trade, etc.?
Yeah, I think what we just saw in the slides is it quite reflects what we're seeing with our documentation services. So yes, there is been a pickup on trade this year compared to 2020, but we are still trying to catch up with the volumes from 2019. We, in terms of Brexit, again, very similar to what we see in the slides. Whilst we see that more companies have been adapting to the new rules, some are still finding it difficult in some areas, but we are seeing an increase in those exporting services, especially for those who are required to send staff overseas to deliver those services. We think that there is still a bit of ambiguity in some of the legislation about what some of the staff can or not do, and let's not to forget COVID and the restrictions for staff when they are traveling back and forth, which is also affecting some of the companies and some of the contracts that they are delivering overseas. But in general, I think we are seeing an improvement. I think June compared to May, we're seeing also a bit of a pickup. Still not quite where we would like to be, but we are also seeing that the export consignment values are higher these first 3 months of this financial year compared to last. So hopefully we'll continue to see that improvement going forward, as we've seen in the slides, and the orders will keep coming through.
Thank you, Susana. I should have actually mentioned there were 3 questions as part of Brexit. Now, I haven't presented the third question, which is the difficulty in the movement of people. And the reason I haven't presented that is because the highest number of responses were in the too early to say category. And that's understandable because at the moment, people are not traveling, as Susana has rightly pointed out. But I think that issue will start emerging once trade resumes. And one of the things to point out, of course, manufacturing businesses amongst you will not only be selling goods, but you might be selling services, and then you might need actually people to travel across the borders. That issue might come to a head sometime later this year. Okay, so on international trade, for now, there is good news. More businesses are getting used to the new regulations under Brexit. So let's look into business confidence. And this is an area where the results start to get really interesting and point to some fundamental issues as well. So on business confidence, we have two questions in the QES. The first is confidence about turnover. So the ability, the optimism that businesses have in being able to maintain their revenues. And then the second is confidence on profitability. So the optimism that businesses can actually maintain profits or margins. Now, on turnover confidence, the chart on the left, there is stability. So I have split this by percentage. So 63% of the respondents in the last quarter said that they expect turnover confidence to increase. So they were optimistic about being able to maintain their sales revenues. An exact same percentage, 63%, have again said that they may expect turnover to increase in this quarter and in the coming months. However, when it comes to profit margins, we have actually seen a decline between the first quarter of 2021 and the current quarter. And actually, that's a significant drop. So in the first quarter, roughly half, I think it was about 48% or so, of the respondents said they expect profitability or margins to improve. In this quarter, that has actually gone down to something like 22%. Therefore, there is a decline in the ability or the optimism that you can actually maintain margins. Now, there are a couple of reasons for this. Inflation has been in the news. There have been increases in the price of input materials, so raw material prices have gone up. There is we have QES questions on that, which I'll get to in a moment. But I think what has happened is, in the last 3 or 4 months, the cost of operations have actually gone up. That's because of increase in the price of energy. It has been because of the increase in the price of raw materials. Shortage of labor has probably caused wage inflation as well. But as a consequence, profit margins are now starting to get squeezed. And as a result, optimism that profitability can actually be maintained has gone down in this quarter. So that 23% is where it was in the second quarter and the third quarter of last year, 2020. So there is that quarterly decline. Now, it may be that it will bounce back in the next quarter, but we have to keep an eye on this. But the one thing is certain, cost of operations have actually gone up at the moment. So that's a business confidence. And then what about capacity utilization? So these are two measures which are extremely important. Now, of course, business confidence is related to cash flow. Business confidence is also related to capacity utilization. And at the moment, there is still a huge amount of spare capacity in the economy. So capacity utilization now in the construction sector has actually gone up significantly. So it stands about 70%. But here's the thing to note. There has been no significant movement between the first quarter and this quarter. So the construction sector has been fairly stable in its capacity utilization. So roughly 70% of the businesses are saying that they're operating at or near full capacity within the construction sector. But when it comes to services and manufacturing, there has been an increase. The capacity utilization was, I think, hovering at about mid-20s for quite some time. That has started improving now. So it has gone above 40. Manufacturing doing slightly better than services, but both of those balances are in the 40s. So capacity utilization has gone up, but there is still some spare capacity. There are two ways in which this can have a macroeconomic impact. Number one, if there is a lot of spare capacity, the ability to raise prices is probably going to be constrained, because that probably indicates that there isn't enough demand. But we know that elsewhere prices have gone up. So in a macroeconomic sense, spare capacity can actually act as a buffer against inflation. And we will have to keep an eye on this again. But once capacity utilization goes up, if it starts approaching the 60–70% mark, that's almost like an optimum level for businesses, because then there is some room for expansion, but then you're operating at an optimum level. But if that happens all of a sudden, under the current context of rising prices, I think we might have more inflation pressures. So at the moment, capacity utilization has gone up. That's good news, of course, from a business perspective. Increase in capacity utilization is absolutely good news. However, there needs to be a further increase in capacity utilization for there to be investment in machinery and equipment. So the chart on the right is a QES question on a business investment. And this is primarily on capital investment, this particular chart. So it looks into the investment that has been made in plant and machinery. Very interesting findings here, somewhat contrasting with the rest of the data. So within the construction sector, the dotted line, green line there, stability, so that completely matches what we have seen with capacity utilization. Capacity utilization has remained the same between the first and the second quarters. Investment in plant and machinery has also remained stable between the first and the second quarters. We have seen capacity utilization go up in services and manufacturing, and we have also seen enhanced business investment in services and manufacturing. However, I don't think there is still room for a significant expansion in investment in productive capacity. And the reason for that is, of course, there is some spare capacity. There are cash flow pressures probably emerging, especially with debt repayments, deferred tax liability, etc., probably going to become due soon. So it remains to be seen how much surplus cash there is to actually invest in capital projects. And of course, there are, in this financial year and next financial year, there are tax incentives for making capital investments. So that's also likely to play into business investment. And one of the reasons these lines have started going up could be a result of those tax incentives, which were announced in the budget in March. So capacity utilization slightly up for manufacturing and services, but stable for construction. And the same goes for investment in machinery and equipment. And then price pressure. So inflation is clearly in the radar at the moment. Now, we have multiple QES questions. I'm just presenting two here. So the one is, the question that is related to the chart on the left is, what are the concerns in relation to price pressures? And this is primarily about business concerns. Now, we know one thing, raw material prices have significantly shot up in the last 6-7 months. Commodity prices, primarily originating from China and the Far East. Commodity prices have gone up. That's where most of the trade is now controlled from as well. So we are seeing commodity price increases. As a result, raw material prices have gone up. But that's not the only thing, though. Financing costs have gone up. So, interest-free loans, etc., are probably harder to come by. C-bills, etc., is going to come to an end soon. We also know that there is a shortage of labor. So clearly, you have seen this in the news: the shortage of drivers, truck drivers, the shortage of health and care workers, shortage in hospitality sectors, etc. And the shortage of labor automatically creates wage inflation. And that's what businesses are finding. So between the last quarter of 2020 and the current quarter, we have seen a significant increase in pay settlements as a matter of concern for businesses as well. Other overheads, again, there was moratorium for rent payments. That moratorium was actually due to end tomorrow, but it has now been extended to March 2022. So that will give some leeway to private tenants, commercial tenants. But again, that could pose some pressures on both cash flow and cause further constraints on business investment, discretionary expenditure, etc. And what I do know is that, from speaking to my colleagues in the membership team, discretionary spend is still on the lower side. And that's probably because of price pressures. It is also a consequence of higher operational costs. So that's on price pressures as a concern. Now, if profit margins are squeezed and there are significant price pressures, the only option that is available is to raise the prices at which goods and services are sold. So This question, the chart in the middle there, that tracks intention to raise prices in the next quarter. And what we have seen again is that it has slowly been going up. So between the last quarter of 2020, where the balance was at just about 15, now that balance is approaching 40. So there is an intention to increase prices. There is another issue that is playing into this. At the moment, economic recovery is primarily fueled by consumer spending. So there has been a huge amount of household savings. That's what is resulting in a huge amount of demand. But as and when demand goes up, there is probably some leeway for businesses to rise prices as well. So there are numerous factors that are influencing price expectations at the moment. So the proportion of businesses who expect to increase prices has been going up. Margins are under pressure, and therefore, an improvement in financial position will likely be used to shore up balance sheets rather than spend on further investment. So we might still see a constrained environment for discretionary expenditure in the next quarter or two. And then finally, on the employment or labor force data from the QES. So, we have seen an improvement in capacity utilization. We have seen an increase in demand. We know that more and more businesses are bringing staff off furlough. And as a result, employment is going up. So on both of these measures, increase in workforce in the last 3 months and an expected increase in workforce in the next 3 months, we have seen improvements for all three sectors. And clearly construction, because of the amount of activity that's taking place in the construction sector, is doing the strongest at the moment. But that is not to say the other sectors are lagging behind. And as we see, the next phase in the reopening, the roadmap, I think we're going to see more and more opportunities for employment. And unemployment, the headline unemployment rate has actually gone down slightly in the latest ONS release as well. So good prospects for employment at the moment. The crunch point is probably going to be the 30th of September. And we have to see what happens once that furlough scheme comes to an end. So that's the presentation. So just a summary, the Greater Manchester Index has gone up by 24 points. That's extremely good news. There's been an improvement in demand and consumer spending that, at the moment, economic recovery is being fueled by consumer spending. There is an optimism, lots of optimism associated with the easing of restrictions, but discretionary spend is constrained. So there is probably going to be a lot of shoring up of balance sheets, as I said. Investment in capital projects are probably not likely to take place immediately, unless, of course, there are businesses who are wanting to make use of the tax incentives. Inflation is an emerging concern, but again, we might delve deep into that later. And the other thing that you might see in this year, there will be big percentage growth. So, 4 to 5% growth in this quarter anticipated, probably a similar percentage of growth in the next quarter as well. But what we have to remember is that we are starting from an extremely low base. And so we do not expect the UK economy to actually return to pre-pandemic levels for another 3-4 quarters, if that, probably a bit later than that. It all depends on how the situation is going to emerge in the next quarter or two. So that's me done. If there are any questions, I'll try and answer them. But Chris, over to you.
Okay, thank you very much, Subrah, once again for 40 minutes or so of fantastic information. And again, just to re-emphasize, this isn't stuff that you've thought of or I've thought of or anybody else. It's come directly from businesses, from members completing the QES, and we can get such an accurate figure. And it was just interesting looking through that. And one thing I always think when I'm watching the slides, and I always forget to mention, but when you're looking at things like domestic order and sales, the orders are going forward, what it should look like in 3 months. You can see how accurate the QES is because the sales figure always matches the orders. It follows the line. If there was a huge discrepancy, you could say, well, the information's wrong or whatever. It follows the line from sales to order, from orders to sales and things. So it just shows you how accurate this stuff is. So when we're saying these things, when Subrah's making his analysis on this, it is based in a lot of information, a lot of facts, and a lot of evidence and experience as well. But I think there's some really interesting things we're going to dig into now. If anybody has got any questions, please pop them in the chat box, and we'll pick them up and get through as many as we possibly can do in the next quarter of an hour or so. Subrah, I'm going to come back to one of the things we've been talking about, and we've got our summer assembly week on Friday, and this is one of the things I want to unpack there as well. This whole issue around inflation and increasing pricing and costs and one thing or another, there's a lot at play here. It isn't just about shipping costs or anything like that. There's everything really being built into this, isn't there? How much of a threat is that? Because inflation is one of these things that people get immune to a little bit after a while, and then all of a sudden it flares up and has a major impact on things. How much of a threat is this inflation growth to that long-term sustained economic recovery?
Okay, thank you, Chris. That's probably the million-dollar question at the moment. So on inflation, we know certain things, as I was saying. So input prices have gone up. Energy prices are up. We're probably finding this in our own household gas and electricity bills at the moment. There is probably some leeway for rising prices because demand is on the up. There are price pressures, so businesses may be forced to raise prices to improve their profit margins. So inflation is probably going to be a concern in the coming months. So the latest Bank of England data said inflation is at 1.5%. But what we have to remember is that that also includes VAT reductions for some sectors like hospitality, leisure, etc. So that a raise in prices and that increase in activity is also fueled partly by the VAT cut. And so some economists are saying, actually, if you were to factor in that VAT cut, then inflation is not at 1.5%. It's probably closer to 2.5% or even higher than 2.5%. And of course, we know that the benchmark for the Bank of England is 2%. What I think is going to be the primary determinant of this is how long is this going to be a concern for? And the Bank of England expects that inflation will probably be at 3% towards the end of the year. There is some consensus around that 3% mark. But then there is going to be a reduction in inflation in 2022. And I think there is probably some credence to that theory, because at the moment, that growth in the services sector is primarily fueled by consumer demand. That's you and I spending in the economy. But that there is an early boost. But if that early boost sort of tails off, then demand will go down. Sorry, I should have said go down. And then at that time, businesses may be forced to resort to discounting to improve sales. So it may be that this may not be a concern for the long term, but for the next 3 to 6 months, probably there are going to be some inflationary pressures.
Yeah, and of course we've heard from the Chancellor as well that we're all sitting apparently on thousands of pounds worth of savings, and we should all go out and spend them. So what that will do to inflation overall, I'm not too sure really. But anyway, well, I know what it would do, but what the end result will be is something else. There's a question just come through in the chat box from Elaine Wood asking about recruitment issues and whether any particular recruitment issues have been raised. I'm assuming that may be sectoral or just anything in particular really that members are highlighted at present.
Yes, there is definitely a sectoral element to it. Hospitality is one area that has been affected. There is probably a parallel with the 2008-2009 recession. So in the 2008-2009 recession, the construction sector was badly affected. And what happened was many people left the construction sector in 2010. So the proportion of workforce within that sector actually shrunk because people either went to other sectors or decided to retire early, etc. There's probably an element of that taking place. This time it's affecting the hospitality sector, I think. So when it comes to skills issues, the usual challenges of finding the right recruits, that's recruitment difficulties for some sectors have gone up to as high as 60-70% of the businesses saying they are now facing challenges in being able to recruit staff. What we did do was to ask all of those extra questions on recruitment difficulties in this quarter. They are not in the slides today, but what we can do is if you could get in touch with us Then once that a summary report about the skills and recruitment issues is ready, we will obviously be happy to share that with you.
Okay, that's great. And we've heard as well, you touched on it briefly, and something we're looking at present is this whole issue around HGV drivers and a shortage there, and that again is a mix of things, isn't it? It's where existing drivers have gone back home, where they're Eastern European, and also a huge drop, nearly 30,000 fewer drivers passing the tests in the last 12 months or whatever. And of course, what's the obvious thing, as always happens when you've got a shortage of workers, your prices start to go up because there is a premium then on the people with the skills. And I think we've heard, for example, where some HGV drivers are now, it's £20 an hour, as opposed to, much less than that. And again, that's feeding into inflation, isn't it? It's there's a real mix of things going on here, both as a result of the pandemic, but also the economic situation as well. There was a comment, I think, from Peter McDermott as well, around cash flow in construction. Obviously, like any recession, when you're climbing out of it, that's when your cash flow problems really hit, and more businesses do go under, don't they, as they're in that recovery phase there. Where are the particular pressures, he says, coming from in the next couple of months?
Is that cash flow pressures?
Yeah.
So obviously, rising prices, input prices are going up. So that's one area where you are bound to have cash flow pressures. There are probably still a proportion of unpaid invoices because many businesses have been shut. They're now opening up, but they are now trying to focus on deploying resources on opening up and increasing their trading activity. So that's probably an area where you are likely to have some pressures on working capital. But the two big things, deferred tax liability is, that's going to be a significant hit. And within the hospitality sector, we will see that cut reversed at some point of time. It's not immediate, okay, it's in the next 6 months or so, but we're going to see that reversed. That's going to put some pressures on cash. And then, of course, debt repayments. So, that 1 year cooling off period for CBILS, bounce back loans, etc., is all going to come to an end. So debt servicing is going to come back into the expenses. And the other thing, of course, Peter, is furloughed staff. So as staff are coming back from furlough, the business has to bear the wages. So that support from the government under the CJRS is also going to an end. So that's another area that will take up cash.
And a real good comment from Sharon Seville as well, as Stockport president, around the big labour market challenge. It's not actually a shortage of jobs, it's the effective redeployment of people into new and growing areas. And again, we've heard a couple of times in the last few weeks, that existing problems with recruitment and skills that have sort of not been forgotten, but they've not been priority over the last 16 to 17 months. They're now suddenly coming back. Let's think where we were 2 years ago. You couldn't open a newspaper or see anything to do with Greater Manchester, whereby people were saying, well, there's a shortage in, digital, or there's a shortage in this, that, and the other. Those problems are still there. And again, I think it's interesting. And I think also as well, I was on a call the other day with somebody and saying there's now an increasing amount of people taking early retirement from various jobs where they can do, obviously, and probably just thinking, well, that's it, my time is done and that's it. So again, some really, really interesting things happening as a result of the pandemic. John Jones from Beaver & Shutters mentioned any specific issues being faced from Brexit-related factors. Well, take your pick, I suppose, on that one, really, Subrah.
Yeah, so Brexit. Let's start with net migration. I think for the first time in many years, we expect net migration with EU to be negative. That's a new. So so those workers in the hospitality sector, for example, because the hospitality sector has a very high proportion of EU workers, more so in London, obviously because of the scale. Again, construction, a very high proportion of EU workers in the construction sector. Again, I think that there is a huge geographical imbalance there. So there are people who have actually returned to the EU. That's going to actually cause pressure on areas outside of London, because what we might see is a pull towards London just to take advantage of higher salaries. That will certainly affect hospitality, construction, but it could also affect professional services, because if you have the flexibility to work 3 or 2 days of the week from home, and you only have to visit the office 1 or 2 days of the week, then I have friends who actually work in central London in fintech. They are moving to Manchester, taking advantage of Manchester cost of living, but central London, city of London salaries in fintech. So you might see those kinds of trends where it's not directly because of Brexit. It's a combination of Brexit, pandemic, etc. But net migration going to negative is completely new. So that has actually put pressure on wages and skills shortages, etc. Then, of course, there are all of those trading difficulties that Susanna was talking about. And although businesses are getting used to it, we still see trade activity with the EU at significantly lower levels. And it is the largest trading market at our doorstep. So single largest trading partner for the UK. And even if you look at the international trade activity country by country rather than by groups of countries, Germany is number 2. Netherlands, France, etc. are all in the top 10. It's a huge amount of trade. It depends on the EU.
Yeah, and it's interesting. Again, we've had this conversation several times. You've had 2 big things happen. You've had the pandemic, and then also you've had the introduction of the Trade and Cooperation Agreement as well. Either event on its own would cause disruption on a huge scale. Put the 2 together, and it's causing disruption. It's very difficult to actually disaggregate which is down to what event, really, sometimes. I think that will probably become a little bit clearer as we work our way through. But there are some things that are obviously to do with Brexit, obviously some things to do with the pandemic, but there's those grey areas still about what the actual cause is, and that makes it difficult then, obviously, to come up with some solutions. I'm just conscious of time. Probably the last question we've got, and it's an absolute corker from Stuart. And again, this is something that's taken up a lot of people's time and thoughts at the present moment in time. But any thoughts on how the likely long-term impact of increased remote working patterns may affect the city and town centre economies, especially around things like the hospitality sector? I mean, that is a real big issue, isn't it? And I'd be interested to hear your thoughts on that, Subrah. You think you're on mute? No.
The bar with the controls just disappeared from my screen. I'm sorry. So me trying the chat at the same time. Anyway, okay. So remote working. So 2 things. One, it's very difficult to say even now. And to an extent, it depends on who you're speaking to. So let me cite 2 surveys. Deloitte did a survey of businesses, and the findings were that half of the employees wanted to return to their normal place of work for half of the week, roughly. But then there was another survey which was done by OBI Property, which said 90% of the workers want to return to their normal place of work. And I think the truth probably lies somewhere in between. So the consensus view seems to be that there will be hybrid working, that the work from home trend is here to stay. But clearly, nobody wants to work 5 days of the week from home. We are losing those boundaries between work and personal life and so on. There are challenges in team building. There are challenges with skills, learning opportunities for younger people. So for all of those reasons, we will be returning to our normal places of work. It may not be visible today, but perhaps in 12 months, 15 months time, we will be working more and more from our offices. I think Stuart was also alluding to a very important point, which is obviously the spend that takes place in the city center. Now, what has happened, of course, is that in the last 12 to 15 months, okay, savings have gone up, so expenditure has gone down. But to an extent, expenditure has also been displaced in addition to being reduced. So we are probably spending a good amount of money elsewhere. So instead of eating out, we may be doing takeouts. Deliveroo is probably thriving at the moment. It is going to have an impact on the city center economy for sure. But it's probably the daytime economy that is going to be affected by the workforce. And I think what we have seen is that since the relevant stages in the roadmap out of lockdown were reached, we have seen the nighttime economy bounce back to a reasonably good extent. So there are still, a few more things. Nightclubs have to open full capacity, big events have to come back. When are we going to see a 2,000, 3,000, probably a 10,000 people attended event at Manchester Central or Men Arena? Those are the kinds of issues that will have long-term impact. But I think the impact is probably on daytime economy. Nighttime economy will probably bounce back before the next quarter.
Yeah, thanks, Subrah. Thank you for that, Stuart. And again, I know I think the Property and Construction Group have got an event coming up sometime around things like the commute of the future. And I know there's been a bit of work done already in town centres and what the changes are that's happening there. And again, I think this is a fascinating area because this still is, still to be decided and still to be agreed. The number of calls and things I go on where people are in discussions about what that hybrid model really looks like. And there's a message there from Sharon about the hybrid model. And it is what it is. It's all sorts of things. So I think it's going to be some time yet before it comes down. But I think there will be some impact at some stage on the hospitality sector, and certainly in the city and town centres. It's how that gets absorbed and changed and renewed, I suppose, is the big thing. And then we'll obviously have to be some changes to public transport rules as well, because at present it can't sustain the demand due to social distancing. So we'll see what happens come 19th of July. Graham Dixon just put a reply to John's previous question around Brexit. And I know Graham's mentioned this previously to me before. The deal was last minute and everyone was assuming it was going to be a no deal with tariffs and one thing and another. So they made alternative arrangements. Then when the deal was actually signed right at the 11th hour, it meant that people's business plans and everything was all over the place. So people ended up losing money and all sorts of things. So you never get it right, I suppose, but they could have maybe given a bit more notice as to what they were actually going to be doing. So anyway, that's the end. We're rapidly approaching 10 o'clock and that hour is absolutely flown by as ever. Thank you very much once again to Subrah for making sense of all that in a totally accessible and informative way. Absolutely superb what you do there. And again, while we've been talking about problems in the questions, let's not forget, Greater Manchester Index has gone up 6 points to 30 points. That is absolutely superb. There's some really good positive stuff there now. I think we can probably lay to rest the Nike tick recovery. So that's a definite W I'm seeing on those charts. So I think we're in a W-shaped recovery. But like I said, some challenges still out there. We will manage that as we always do in this fantastic business community we've got in Greater Manchester. Thank you so much for joining us today. Look out, we'll be sending out more information, the slides, etc. If you've got anything you want to comment on, please let us know. But in the meantime, enjoy the rest of your day. And thank you very much for joining us this morning. Thank you.